Hello learners, once again welcome to Manifested Publishers e-learning platform. We are proceeding with revision for September 2021, Advanced Financial Reporting. We're going to go to question 2, which is testing your understanding on earnings per share, that is IAS 33, and IFRS 8, that is segmental reporting. I'll read the question and then we answer it together. Question 2A. The following capital structure relates to Shell Limited as of 31st December 2020. Ordinary shares of 10 shillings each, 10% cumulative preference shares of 20 shillings each, 12% convertible loan notes of 10 shillings each, and profit after tax for the year is given. Additional information: on 1st February 2020, the company issued 1.5 million ordinary shares at full market price. 2. On 30 June 2020, the company made a rights issue of 1 ordinary share for every 4 shares held on that date. The exercise price was 36 shillings per share, and the market price on the last quotation was 48 shillings per share. Number 3. The convertible loan notes were issued in the year 2018. 10 convertible loan notes are convertible into 1 ordinary share. Number 4. On the 1st October 2020, the employees of the company were granted share options to purchase 1 million ordinary shares at shillings 30. The average market price was 48 per share. As of 31st December 2020, none of the employees had exercised their options. 5. The corporation tax rate is 30%. Required: basic earnings per share for the year ended 31st December 2020 in conformity with IAS 33 earnings per share. And 2. Diluted earnings per share for the year ended 31st December 2020 in conformity with IAS 33. Now, before you start answering such a question, you need to first understand that basic earnings per share is affected by certain items that some of which also affect diluted EPS. What are these elements that affect basic EPS? Basic EPS is affected by the following items that affect ordinary share capital. 1 is normal issue of ordinary shares. Number 2, we have rights issue. Number 3, bonus issue. Number 4, share split. Share split could be reverse share split or share consolidation. What I mean by share split, we could be having share split that increases the number of shares but decreases the market price per share. And we also have the share consolidation, or what is called reverse share split. Actually, this is out of financial reporting. This is one way that a company can use to increase number of shares if it projects oversubscription. It can also use the reverse share split to reduce the number of shares in the market to avoid hostile acquisition. We also have what is called conversion of potential ordinary shares. Now, when you talk of potential ordinary shares, I mean those financial assets like convertible loan stock, convertible debentures, convertible bonds that have the ability of making the holder become an ordinary shareholder at a future date. Now, when actual conversion of a potential ordinary share takes place, then it is going to affect basic EPS. It is going to affect basic EPS. We also have issue of shares as purchase, issue of shares, issue of ordinary shares as purchase consideration. Let me say for purchase consideration. This is during acquisition. This is also affecting basic EPS. So in this question that we're going to do, which of these are included that we're supposed to incorporate in determining basic EPS that are going to affect the weighted average number of ordinary shares that we use to determine basic EPS? And number two thing that you also need to understand is how to determine the profit or earnings attributable to ordinary shareholders. Meaning, what earnings are the shareholders entitled to? These earnings are normally given by or determined by profit after tax minus the attributable to NCI, profit after tax to NCI, because when determining EPS, we are determining the earnings per share for the parent. We also minus preference dividend. And the preference dividend we minus here is dividend for convertible preference shares because it is having the equity characteristic. The dividend on cumulative preference shares is assumed to have been accounted for in the finance cost when we are consolidating or during the preparation of income statement. And also we minus profit on discontinued operations, meaning operations that or business lines that the parent company or that the company has sold. So meaning that these profits are no longer part of the profit after tax. So again, in this our question, which of these items that reduce profit after tax attributable to shareholders are included? And now we can proceed and read the question again. So in the capital structure, we have ordinary shares of 10 shillings each, 10% cumulative preference shares of 20 shillings each, 12% convertible loan notes of 10 shillings each, and profit after tax for the year. So with that information, we can determine earnings attributable to ordinary shareholders. So profit after tax is 171,200. And then we minus preference dividend. %12 of 50,000. That gives us 0.12 times 50,000 as 6,000. So 171,200 minus answer is 165,200. So this is earnings attributable to. Now, after that, determining the earnings attributable to ordinary shareholders, we now proceed to determining what is called per share or weighted average number of ordinary shares, which is based on some of those items here that affect the capital structure. So this is working 1, working 2, weighted average number of ordinary shares. We call it per share. So how do we start? Before we proceed to any of this, we must first determine the opening balance or number of ordinary shares that were outstanding at the beginning of the financial year. So by 1st January 2020, very important. It is also very important to determine whenever you are dealing or calculating earnings per share, it is very important to know when the financial year begins and when it ends to help you know how to do the weighing of the shares that comes as a result of these items that affect capital structure. Okay, so opening balance. So number of ordinary shares outstanding in bracket 60,000 divided by 10. So shillings in thousands here. So this is 6,000. Then we can proceed to to additional information. One, on February 2020, the company issued 1.5 million ordinary shares at full market price. What if not at full market price? Suppose they were issued at half market price. What happens? So when it is issued at half market price, then apart from the time waiting factor, the half market price will also be used to weigh the issue. So if at all the market price was 80 and we issued at 60, then when doing the weighing, we have to do 60 over 80 because these shareholders are not entitled to the full dividend because they didn't pay the whole market price of the shares. They're not entitled to earnings. And so, but in this case, it is full market price. So we don't have any worry there. So on 1st February 2020, we have issue of new shares. From 1st February to the year ends on 31st December. So our financial year begins on January and ends on 31st December. Very okay for us. We are issuing shares by 1st February. That means that the shareholders that are subscribing to these shares are entitled to earnings for how many months? February to December is 11. So it will be 11 over 12 times 1.5. So 11 divided by 12 times 1500, giving us 1375. Then the next item that affects basic EPS is number 2. Additional information 2. On 30th June 2020, the company made a rights issue of 1 ordinary share for every 4 ordinary shares held on that date. The exercise price was 36 per share, and the market price on the last quotation was 48 per share. What is rights issue? It is an undertaking by a company to issue shares to the existing ordinary shareholders at a price below the existing market price as a way of motivating them to take the risk of adding their or increasing their shareholdings. That means that rights issue is a way of attracting finance by a company without going to the public market because it wants to avoid flotation costs. Now, in this case, we're going to, whenever we have rights issue, there is what is called theoretical ex-right price that we have to establish, meaning the price of these shares after the rights issue. It is going to help us in doing the weighing of the shares before and after the rights issue. So how do we get theoretical X right? Before I get it, we can write that by 30th June 2020, there was rights issue. So we have to deal with rights issue. And I will say that whenever we have rights issue, we must determine the theoretical X right price. So working 3 here, theoretical. Maybe I can just determine it here so that we avoid having many workings. So theoretical X right price. So X right price is given by, the formula is number of ordinary shares before rights issue times market price per share plus number of ordinary shares issued during rights issue times exercise price over number of ordinary shares before rights issue plus number of ordinary shares issued during rights issue. Yeah, to some students, at times it is not a very friendly formula, but I'll make it easier for you. There are two ways we can go about this. The first one is this. Up to date, we have, if we add this, we have 7,375 ordinary shares. That means that the number of shares before rights issue is 7,375. Then how many shares were issued during rights issue? You get that by looking at the terms, 1 for every 4. So the number of rights is 4, 1 for every 4. So that means I could take 7,375 times the market price per share is 48 plus, we call this come right price as well. That is the market price per share before rights issue. And the number of shares will be number of ordinary shares issued during rights issue is times 1/4. This is getting the number of shares issued during rights issue. Then times the exercise price, which is 36, over 7,375 plus 1/4 times 7,375. This is option 1. Then option 2, I can go the direction of per unit. If you are told 1 for every 4, 1 for every 4, that means that for every 1 share that you have, for every 4 shares that you have, we give you 1 during the rights issue. We give you 1 right, okay? So that means that the shares before rights issue is 4. Then the shares offered during rights issue is 1. So this can also be given by 4 times 48 plus 1 times 36 over 4 plus 1. The two should give you the similar answers. So this is option 2. This is option 1. So my exercise X right price, I can adopt option 1, option 2, which is 4 times 48 plus 1 times 36 over 4 plus 1. Calculating that, we have 4 times 48 plus 1 times 36 divided by 5, giving us ex-rate price as 45.6. This is the ex-rate price. This was the come-rate price. So the market price per share before rights issue is 48. After rights issue, it has fallen. Now, once you get your theoretical ex-rate price, you now go to what is called weighing. We have to determine the number of months before rights issue and number of months after. The issue took place on 30th June. That means that we had 6 months before and 6 months after. This is going to help us in doing the weighing. This is how we do it. Step 1. We use number of shares before rights issue, 73.75 times 6/12 times the come-rate price over ex-rate price. That is first step. Step 1. And step 2, you're going to determine the shares, the ordinary shares after rights issue, which is 73.75 plus we have 1/4 times 73.75. That means that this is before, this is after. Total shares to date is these two added, but we had this for only 6 months, so times 6/12. Now, when we do this, we don't forget about this because you can see we've used the opening, that this is the shares before rights issue. You can see it has been used here severally in doing the weighing, and so we now shift to this point. This is now our point of focus. We don't forget about this because you're not going to aggregate it during the adding. So can we add now 73.75 times 6/12 times 48/45.6. So you get here 3,882. 73.75 plus 0.25 times 73.75 times 0.5. You get 46.09. Now, before we aggregate, we have to go back to the equation and see if there is any other of this, that of normal issue, rights issue, bonus issue, share split, conversion of potential ordinary shares, issue of ordinary shares for purchase consideration, if there is still any of them that we have to incorporate here. The number 3 is the convertible loan notes were issued in the year 2018. 10 convertible loan notes are convertible into 1 ordinary share. So none of it has been actually converted. All of them has remained potential. So doesn't affect basic EPS. On 1st October 2020, the employees of the company were granted share options to purchase 1 million ordinary shares at 30 each. Again, options is also a potential ordinary share that allows employees to become shareholders at some future date. So we can aggregate now. That means that our per share or weighted average number of ordinary shares after the rights issue is now 3882 plus 4609. That is 8491. And so basic EPS is equal to earnings attributable to ordinary shareholders over weighted average number of ordinary shares, which is equal to 165 200 over 8491, and you get 19.45 per share. So basic EPS is equal to shillings 19.45. That is basic earnings per share. Then Roman 2, this is Roman 1. So we answered Roman 1, which was in need of basic earnings per share. And just to recap, these are the fundamental elements that affect the ordinary shares. Whenever you're determining basic EPS, please look for any of these in the question so that you don't bypass it when determining basic EPS. The next is diluted EPS. What is diluted EPS? This is a watered down basic EPS as a result of potential ordinary shares. And now, what are potential ordinary shares? These are financial assets that gives the holder the right to become a shareholder at some future date. So when we determine diluted EPS, we are trying to be pessimistic of the future concerning the basic EPS. That suppose the holders of convertible preference shares, the holders of convertible debentures or loan stock or bonds, the employees exercise their options. If suppose these people become shareholders in the future, what will be the impact on the basic EPS? Is it going to decrease or increase? As a matter of fact, most of potential ordinary shares are dilutive in nature, meaning that they decrease the basic EPS. Some are antidilutive, meaning that they increase the basic EPS instead. From my explanation, you can note that for us to determine diluted EPS, it means that we first have to identify potential ordinary shares. So what are the available potential ordinary shares here? Now, in our question, the potential ordinary shares available can be got in additional information 3, where we are told that the convertible loan notes were issued in the year 2018, and the conversion ratio is 10 convertible loan notes are convertible into 1 new ordinary share. Another potential ordinary share is the options. Number 4, on 1st October, the employees of the company were granted share options to purchase 1 million ordinary shares at 30 shillings each. The average market price was 48 per share. As at that date, none of the employees had exercised the options. According to IS 33, you are required to assume that the employees will exercise the options so that you proceed with determining the diluted EPS, projecting the diluted EPS. So we only have two. So number one, this is answering Roman 2. A, we identify potential ordinary shares. In this case, you only have two. So Roman 1 is the convertible loan stock, 12% convertible loan stock. And 2, options. The next thing is to determine incremental EPS. Incremental EPS. Determine incremental EPS for ranking. Ranking here means we rank the potential ordinary shares in the order of dilution, the most dilutive and the least dilutive, based on the incremental EPS. So can we get incremental EPS, which is given by earnings saved on the potential ordinary share over incremental shares, ordinary shares, as a result of the potential ordinary shares becoming shareholders. Now, let us get incremental EPS for 12% convertible loan stock. Loan note. It is loan note, not loan stock. So what do? We get earnings saved. Now the earnings saved on, maybe you're asking yourself, what is earnings saved? I would say that potential ordinary shares are those securities that allows the shareholders to convert that security into ordinary shares. Now we saying that in case these people, the holders of these 12% convertible loan notes, become shareholders, then the company is going to save on the interest that is supposed to pay them. So this is the earnings saved here, which is 12% times 50 million. And recall that interest is taxable. So that gives you 12%, 0.12 times 50,000 times 0.7. So the earnings that the company is going to save, or the interest that the company is going to save as a result of the 12 convertible loan notes becoming shareholders, is 4,200. And then what is the incremental shares, or the per share ordinary shares? The terms of conversion is that 10 convertible loan notes are convertible into 1 ordinary share. So how many loan notes? Number of loan notes is equal to 50 divided by 10, because you're told that the price for each loan note is 10, so we have 5,000 loan notes. The next, 10 of these loan notes is equivalent to 1 ordinary share. So that will be now 5,000 over 10 times 1 ordinary share. which is equal to 500. Therefore, incremental EPS is equal to 4200 divided by 500. That gives us 8.4. The next number, that is the first one was this. And then the next is incremental EPS on the options. You say that the options are assumed exercised, and so the earnings saved here is 0 because there is no obligation we were paying before. Earnings saved is equal to 0. Incremental shares is given by this. If I assume exercise, this is how you get it. 1 million options minus 1 million options times exercise price over fair value it was 30, not 36, times the duration that we're going to have these employees in the company, that is 3/12. If you do that math, you get 1 million times 30 divided by 48 times 0.25. 1 million minus that, 843,750. Incremental EPS is 0. So this is ranked number 1. Why 0? Because 0 divided by this is 0. This is ranked number 2. After doing this, you can now go to determining diluted EPS, meaning that we now want to see the impact of these potential ordinary shares on the basic EPS. So this is how you do it. You can have a table like that. This is details, earnings, then per share, and EPS. Recall that you are determining the impact of potential ordinary shares on the basic EPS. So you start with the basic EPS. Basic earnings was 165 and the shares were 8491, giving you 19.45. Then we start with the most dilutive. We start with the first ranking. So what is the impact of options? It was number 1. The earnings, incremental earnings is 0. Incremental shares is 844. We round off 844 because everything is in thousands. So this is 843.75. So we cumulate. If you cumulate, you get 165,200. 8491 plus 844 You get 9335. Your EPS is 165,200 divided by answer. You get now 17.70. You can see it has, the option is dilutive. It has watered down our basic EPS now to 17.70. Then the next ranking is 12% loan note. Number 2, the earnings saved were 4,200. Aggregate there. Incremental shares was 500. This is 169,400. And the other one is 98,35. What is the impact? 169,400 divided by 98,35. 17.22. So therefore, our diluted EPS as a result of the potential ordinary shares is 17.22. This means that suppose this suppose the 12% convertible loan notes becomes shareholders and the options are exercised, then the basic EPS of 19.45 will be watered down to 17.22. And so, just as Andy had indicated, potential diluted EPS is a way or a means that the management is using to project the impact of potential ordinary shares on the basic EPS. Now, just to mention, EPS is a financial indicator that can be used by the management, can be used by the shareholders to evaluate the performance of the management, because they are the contributors of capital to that company, and therefore their interest is what earnings or what is the benefit they're deriving from that investment. Thank you for that. We're going to go to question 2. Question 2B, which requires your understanding of IFRS 8 segment reporting. I'll read the question. Tandaza Limited is a conglomerate whose equity shares are quoted on the Nairobi Security Exchange. The group manufactures, distributes, and retails food products. The group also operates a hotel chain for purposes of diversifying its revenues. The group's financial controller wishes to know if IFRS 8 operating segments applies to the entity, and if so, what segment should be reported on. He informs you that the operating results of each of the divisions represented below are internally reported separately to the chief operating decision maker. The following information is available. We have revenue, external, revenue internal, profit or loss, assets, shillings in millions, for business, manufacturing, distribution, retailing, hotel chain. By applying the requirements of IFRS 8 to the above information, explain which of the above business of Tandaza Limited are reportable segments. Okay, so IFRS 8 segment reporting do have two ways of identifying a reportable segment. We have the quantitative threshold, and you also have the aggregation criteria. Aggregation criteria will identify a reportable segment if the segments are similar in various aspects. That is not applicable here because you can see manufacturing, distribution, retailing, and hotel chain all are different business lines. And therefore, we're going to adopt the quantitative threshold. What does it say? It says that an entity shall identify a reportable segment if the following applies. 1, if its total revenues, that is internal plus external, is 10% or more of the total revenue. 2, if the segments that reported profit have 10% or more of the combined profit. Number 3, if the reported loss is 10% or more of the combined loss of the segments that reported a loss. And number 4, if the segment assets is 10% or more of the combined assets. And once you determine that you carried out the test, all these 3 tests, you also need to carry out the 75% test. That is, if the external revenue of these reportable segments is 75% or more. Now, for you to answer this question, you have to first carry out the 10% test or the 10% threshold test for you to determine the reportable and non-reportable segments. So let us proceed. Let's proceed to determine So let's carry out our 10% test. So revenue. So we have manufacturing, distribution, retailing, and but we don't need to do that. That will be quite laborious. What we need to first do will be very laborious and time wasting. The total revenues that we have here is 460 plus 250 plus 5 plus 42 plus 750 plus 15 plus 150 plus 3. That gives us, if we add, we're going to have 460 plus 250 plus 47 plus 750 plus 15 plus 153. You have there 1675. This is total revenues. 1675 is the total revenue there. And so 10% of this is 167.5. Therefore, any segment that is serving 167.5 revenue is reportable. So you say, therefore, any segment with 167.5. Can talk of revenue first. 167.5 is reportable. It's reportable. Okay. So the next is profit test. Profit or loss test. What is the total profit? Is working 1. That is 3 plus 32 plus 75. That gives you 78 plus 32 is 110. So times 10% is 11 million. Then loss is equal to 14 times 10%, 1.4. So you say therefore any segment with a profit or loss of 11 or above 11 million and above is reportable. Working 3 asset test. Asset test, we have total assets is 1450 plus 250 plus 375 plus 100, giving us, let's add, is 1700 plus 375, 2175 times 10%, 217.5. Therefore, any segment with assets worth 217.5 M or more is reportable. So with that, we can now determine our reportable segment here. We can now answer our question, being guided by the working. So revenue test, profit or loss test, and asset test, then report. So manufacturing, revenue test, what is manufacturing? Total revenue, 460 plus 250 is 710. 710, our revenue here is the 10% test is 167.5. So it has surpassed that by far. So you say yes. Then profit or loss is 32. Yes. Asset test 217.5. Yes. Is it reportable? Yes. Then distribution. Distribution. Is it meeting any of the test? Revenue? No. It is 5 million plus 42, 47. Profit or loss? No. Asset test? No. Asset test? Yes, because it is 250. No. Retailing, we have 750 plus 15, 765, yes. Profit test, it is passing, it is serving 75, yes. Asset test, yes. Reportable, yes. The last one is hotel chain. Hotel chain. 150. Is it passing the test? No. Profit test? No. Asset test? No. No. Now, we can't finish that question without looking at the 75% threshold. That is, the segments that are reportable. Is their revenue 75% or more if compared to the total revenue that they have? So the reportable segments that we have here is manufacturing. So let us determine 75% test. 75% test. Let's determine 75% test of the reportable segments revenue. So manufacturing plus retailing revenue, 460, 750, this is 12 of 10. The external revenue, this is of course external revenue, external. Then total external revenue is equal to 460 plus 5 plus 750 plus 150, giving you 460 plus that's 465 plus 900, 1365. So 1210 over 1365 times 100. What do you get? That is 88.6. So the reportable segments external revenue are going past the 75% threshold. And so this is an emphasis of what we've just done here. We will not proceed to conclude that manufacturing and retailing are reportable segments without determining the 75% test. And so we can conclude that also based on 75% test, manufacturing and retailing are reportable segments because their external revenue is above 75% of the total external revenue from all the segments. That is the end of number 2. That was testing your knowledge on IFRS 8 and IAS 33 earnings per share. Thank you for listening. I welcome you to the next session where we're going to look at question 3, September 2021, which was requiring you to elaborate more on IAS 12. Thank you.
So we answered part A. Then part B, I read, the following details relates to the machines owned by Ujenzi contractors. Machine A, machine B, machine C, machine D, machine E. We are given the cost of each machine and the date of purchase of each machine. Ujenzi contractors' depreciation policy is as follows. Number one, machine A and B are depreciated on a straight line basis with no scrap value over 10 years. Number two, machine C is depreciated on a reducing balance basis at 20% per annum with a scrap value of 5 million shillings. Number three, machine D and E are depreciated on straight line basis over 5 years with a scrap value equal to 10% of the original cost. Number four, a full year's depreciation for each machine is provided in the year of purchase. Required. A property, plant and equipment schedule from 1st January 2011 to 31st December 2020 with the following details. Number one is the date of purchase. Number two, cost. Number three, annual depreciation. Number four, accumulated depreciation. Number five, net book value. Total 10 marks. 10 marks. Candidates, we will answer this question, and you can see the examiner was lenient enough to give a hint on the columns that are required when preparing the property, plant and equipment schedule. This is property, Ujenzi contractors. The question says property, plant and equipment schedule from 1st January 2011 to 31st December 2020 with the following details. We have the first detail is date of purchase, date. The next one is cost, but before cost we'll have the machine. We have machine A, B, C, D, E, cost, the cost in thousands. Then we are going to have the annual depreciation, annual depreciation. Another column is the accumulated depreciation. Then lastly, we have the book value. The book value. These are the columns. Date, machine, the cost, annual depreciation, accumulated depreciation, book value. That is, those are the columns. The dates are shown. There is 2nd January 2011. On this date, candidate's machine A was purchased at a cost of 26 million. We are now going to calculate the depreciation. We read from the question that depreciation machine A, straight line basis, no scrap value. Candidates, when calculating depreciation using the straight line method, we know that depreciation per annum is equal to cost minus scrap value divided by the economic life. So the depreciation charge, depreciation per annum for machine A will be equal to the cost minus scrap value divided by the economic life. This is equal to 26 million divide minus 0 over 10. This gives me 2.6 million. That is the depreciation per annum. Depreciation per annum. Annual depreciation is 2.6 million, 2,600. Accumulated depreciation will still be 2,600. The book value will be equal to the cost minus accumulated depreciation. Cost minus accumulated depreciation. The cost is 26 million minus 2,600. This is equal to 23,400,000. That's the book value. In year 2012, the company still had machine A. The cost is 26 million. Annual depreciation, we calculated it, 2,600. Accumulated depreciation will be this book value minus 2.6 million minus 2,600. The accumulated depreciation candidates, accumulated depreciation before book value, the accumulated depreciation will be 2.6 plus 2.6, which is equal to 5.2. 5.2 million. Therefore, book value. So candidate, the book value, there are two ways you can calculate the book value. We either deduct the accumulated depreciation of 5.2 million from 26 million. That's one way. Another way is to deduct 2.6 million from the book value. Let me use the accumulated depreciation. We know, candidates, book value is equal to cost minus accumulated depreciation. So the cost is 26 million minus accumulated depreciation of 5.2 million. This will be equal to 20,800,000. That's year, the second year. The third year, 2013, is there any purchase? In 2013, yes. In 2013, machine B was purchased. That is, machine B was purchased here, 2013. The date is November 17. The cost, 15 million. 15 million. So we are going to calculate the accumulated depreciation or the annual depreciation first. We are going to calculate the annual depreciation for two machines, because in 2013 we have machine A and B. Okay, machine A and B. Then we will also have the cost for machine A and B. That will be 26 plus 15 million. 26 plus 15 million. That will be 41 million. 41 million. This is 41 million. Candidates, hope you have seen what I've done. I've added the cost of machine A to the cost of machine B to get 41 million. When it comes to calculation of annual depreciation, again, I'm going to have the annual depreciation for machine A and annual depreciation for machine B. I'll have it as a total. The annual depreciation will comprise the annual depreciation for machine A and annual depreciation for machine B. We combine and have the total. We know the annual depreciation for machine A, we calculated here. We will then calculate the depreciation per annum machine B. The machine B straight line method is cost minus scrap minus scrap value over economic life, which is equal to 15 million minus 0 divided by 10 is equal to this is 1.5 million. So 1.5 million is the annual depreciation of machine B, and the annual depreciation of machine A, 2600. So we are going to combine the two, 2600 plus 1500. The annual depreciation is 4.1 million. 4.1 million. Then we will have the accumulated depreciation. Accumulated depreciation, candidates, again will be the accumulated depreciation for machine A and accumulated depreciation for machine B. The accumulated depreciation at the end of year 3, this is the third year for machine A, accumulated depreciation will be 2.6 million times 3, okay, plus the annual depreciation for machine A, which is 15 million. So the total accumulated depreciation is 9.3 million. 9.3 million. So we are going to determine the book value, and the book value will be the book value for the two machines. Book value for the two machines. How do you calculate book value? Book value is equal to the cost minus accumulated depreciation. The cost for machine A and B is 41 million, and the accumulated depreciation of machine A and B, 9.3 million. So 9.3 million deducted from 41 million, that will give us 31,700. That is the book value, machine A and B. Then we move on to the year 2014. 2014. Was there any purchase in 2014? Yes, 2014 machine C was purchased, and that is on 30th June 30th, machine C was purchased. Therefore, in the year 2014, there are three machines, machine A, B, and C. A, B, and C. So the cost of machine A, B, and C will be the cost of machine A, B, which we have here, 41 million, plus the cost of machine C from the question, 47,500,000. 47,500,000. Total cost, 88,500,000. We now move to calculate the annual depreciation for machine A, B, and C. We already know the annual depreciation for machine A and B, but we need to calculate the annual depreciation for machine C, which we read from the note number 2, that machine C is depreciated on reducing balance basis at 20% per annum with a scrap value of 5 million. So we are going to calculate here depreciation machine C. we know the cost is 40. Machine C, the cost is there is 47,500. 47,500. Depreciation per annum year one. Depreciation year one will be equal to the rate there is 20%. Will be 20% times 47 times 47. The first year, this will be 9,500,000. So I'm going to deduct it to get the book value, minus 47,500, 38 million. Depreciation year two will be 20% of this amount times 20%. This will be equal to 7.6 million. We deduct 38 million minus 76 is 30,400. Then depreciation year three, again 20% of the net book value times 20%. This is 6080. Deduct to get the net book value, minus 30,400 is 24,320. 24,320. Depreciation year 4, 20% of the net book value times 20%, 4864. Deduct from the net book value 24,320. This is equal to 19,456. Depreciation year 5, 20%, 20%, 20%. This is times 20%. This is equal to 3891.2. Deduct minus 19,456. Getting here 15,564.8. That is the net book value year 5. Then depreciation year 6, 20% of that amount times 20%. This is 31,102.96. That is the minus 155.64.8. It's 12,45, 1.84. Then lastly, we have depreciation year 7, 20% times 20%, 24,990. This is 364 minus, we get the net book value, 1245, 1.84, 9 961.472. So candidates, these are the computations. These computations will help us determine the depreciation, the annual depreciation for machine C. The first year, we have it there, second year, third year, fourth year, fifth year, sixth year, and seventh year. So now, let's move on. Let us move on with our schedule. Let's move on with our schedule. We are at this point. Annual depreciation machine A, B, C. Annual depreciation machine A, B, C. At the end of the fourth year, candidates, at the end of the fourth year, we have depreciation, accumulated depreciation for three machines. There are many ways to go about it, but let me take it slowly. All right, let me take it slowly, because candidates, here we already have the annual depreciation for machine A and B. 4100 accumulated depreciation for machine A and B at the end of the third year. So we can choose to take this 4100. We add accumulated depreciation for the year for machine A, which we know is 2600. Then we add the annual depreciation for machine B, which is 1500 plus 1500 plus the annual depreciation for machine C. The first year is 9500. 9500. This is equal to 13,600. Annual depreciation machine A, B, C. Machine A, B, C. Annual depreciation machine A, B, C candidates. I've taken the annual depreciation for machine A. I want you to move with me. 2600 plus annual depreciation machine B, 1500 plus annual machine C, 9500 to get 13,600,000. Now let's move to accumulated depreciation. Accumulated depreciation candidates, you are going to accumulate the depreciation for machine A, B, C. Machine A, B, C. Machine A, B, C. Machine A, it has been in existence for 4 years. Okay? For 4 years. So firstly, machine A accumulated depreciation at the end of the fourth year will be 2600 times 4. Then machine B has been in existence up to 2014 for 2 years. So we add 1500 times 2 plus machine C, which has been in existence for only 1 year. 1 year, candidates, 1 year. So we add the depreciation for the year for machine C for 1 year, the first year, which is 9.5, 95. So the total accumulated depreciation is 22,900. 22,900. Then we do the book value. Book value, we know, candidates, is the difference between the cost and accumulated depreciation. The cost minus accumulated depreciation, 88,500. This is equal to 65,600. 65,600. We move on to the year 2015. Were there any purchases in 2015? No, there was no purchase. So therefore, candidates, the machine in existence at the end of the year 2015 will just be A, B, C. A, B, C. The cost remains 88,500. We will now determine, candidates, the annual depreciation. The annual depreciation for machine A, B, C. Machine A, B, C. We know the annual depreciation for machine A is 2,600. For machine B, 1,500. For machine C, the second year, because this is year 1, year 2. For second year, machine C depreciation is, this is second year, 7,600. We add 7,600. So annual depreciation for the 3 machines will be 11,700. Now, when it comes to the accumulated depreciation, candidates, I can avoid the longer method. The shorter method here is we just take the accumulated depreciation for the previous year. At the end of the previous year, we add the depreciation for the year. This is the total accumulated depreciation for the previous year. We add the annual depreciation for the current year. So I'm going to take 11,700 plus 22,900. 22,900. This will be 34,600. 34,600. The book value, we know, is cost minus accumulated depreciation, minus 88,500. It's equal to 53,900. 53,900. We are moving on to the year 2016. Was there any purchase in 2016? No. 2016, there are the 3 machines A, B, C. The accumulated cost is still 88,500. Annual depreciation will be the depreciation for machine A. Annual depreciation is 26. Annual depreciation machine B, 1,500. 1,500. Annual depreciation machine C, the third year machine C, depreciation machine C, third year is 60,80. 60,80, which is equal to 10,180. 10,180. This 10,180 will help us calculate the accumulated depreciation at the end of the year 2016. We take this amount, add 34,600 plus 34,600 is equal to 47. This is 44,780. 44,780. Book value will be 88,500 minus 44,780 minus 88,500. This is equal to 43,720. 43,720. Moving on to the year 2017. Was there any purchase in 2017? Yes. Machine D was purchased on 10th May May 10. May 10, machine D was purchased. So in 2017, there are 4 machines, A, B, C, and D. The cost is 18 million. Therefore, the accumulated cost is going to be 88,500 plus 18 million. 18 million. That is the cost, 106,500. 106,500. Then we'll move on to calculate the annual depreciation. But first of all, we need to check how is machine D depreciated. We read in note number 3 that machines D and E are depreciated on straight line basis over 5 years with a scrap value equal to 10% of the original cost. We are going to have a working depreciation for machine. This is machine D. Depreciation per year, machine D. We have seen that the depreciation is on straight line basis. So the depreciation per annum will be equal to cost minus scrap value over 5. The cost is 18 million. The scrap value we've seen is 10% of the original cost. So 10% times 18 million, this is equal to 1.8 million divided by 5. Divide by 5. So 18 million divided by 1 minus 1.8 divide 5. This is equal to 3.24 million. 3.24 million is the depreciation per annum on machine D. 3.24 million. So we are now going to calculate the annual depreciation for the 4 machines A, B, C, D. We know the annual depreciation for machine A is 2,600, machine B 1,500, machine C. We are now in which year machine C? The 4th year. The 4th year machine C, 4th year, we have it there. That is plus 48,64 plus depreciation for machine D, which you have calculated here. Machine D will be equal to 3240. So candidates, the annual depreciation is 12,204. That is the annual depreciation. Then accumulated depreciation, we take the accumulated depreciation the year preceding 2017, which is 2016. We add the annual depreciation for the current year 2017. We add 44,780. This is equal to 56,984. That is the accumulated depreciation. Book value will be equal to the cost of 106,500 minus 56,984 minus 106,500. The book value, all the machines, is 49,516. 49,516. We move on to year 2018. 2018, is there any purchase? Yes. That is on October 9th. October 9th, machine E was purchased. So in 2018, we have machine A, B, C, D, E. What is the cost? The cost, we are going to add the new machine which was purchased at 110, that is 110 million plus 106 500. The cost has gone up to 216 500. So what will be the annual depreciation for machine E? That's what we need to calculate. Annual depreciation machine E. Machine E, depreciation machine E, depreciation per annum. Machine E, we read that machine E is depreciated at the rate of is depreciated on a straight line basis over 5 years with scrap value equal to 10% of original cost. The formula is cost minus scrap value divided by the number of years, 5 years. So the cost here is 110 million minus scrap 10% of this, 11 million divided by 5. Divide by 5. So I have 110 million minus 11 million divide 5. This is equal to 19.8 million. 19.8 million is the annual depreciation machine E. Now we come to the column for annual depreciation. We know, candidates, machine A annual depreciation is 2600. Machine B annual depreciation is 1500. Machine C, this is 5th year machine C. 5th year machine C, year 5 machine C, the annual depreciation machine C 3891.2. That is year 5. Then machine D, we have it here, 3240. Machine E, we have it there, 19,800. So the annual depreciation for all the machines, I have annual depreciation for all the machines. I have 31.2. That is the annual depreciation. Annual depreciation. We now go to the other column, accumulated depreciation. Accumulated depreciation, we are going to take this previous accumulated depreciation, we add the current annual depreciation plus 56,98,4. 56,98,4. Annual accumulated depreciation 88,01 5.2. Book value, accumulated depreciation, we deduct from the cost. Deduct from the cost of 216,500. Book value, the book value is 128,484.8. You are moving on well, candidates. We are moving on well. We move to the next year, 2019. There is no purchase in 2019. The machines still remain A, B, C, D, E. The cost remains 216,500. The annual depreciation will be equal to 2,600 plus 1,500 plus machine C. This is year 6, machine C, year 6 depreciation is 3112.96. Depreciation machine D 3240 plus 3240. Depreciation per annum machine E 19800. So I have the annual depreciation here is 3252.96. Accumulated depreciation, I add this amount to this amount plus 880.15.2. I get 11,268.16. Book value, I deduct this accumulated depreciation from the cost minus 216,500. This gives me 982,301.84. Then moving on to the year 2020, because candidates, we are to prepare the property, plant and equipment schedule up to December 2020. This is the last year. There is no any other purchase of machine. There are only A, B, C, D, E. The cost still remains 216,500. The annual depreciation will change. Machine A 2,300. Machine B 1,500. Machine C, the last year here is 2,490 plus 2,490.364. This last year 0.64 plus depreciation per annum machine D 3240. Machine E 19,800. Therefore, candidates, the annual depreciation will be 29,630.364. That is the annual depreciation. Accumulated depreciation, we add this annual depreciation to the previous accumulated depreciation. We add 11,82,68.16. I get 147,898.524. That is accumulated depreciation. Book value, we deduct this accumulated depreciation from the cost of 216,500. So the book value 68,601.476,476. That is the property, plant and equipment for Ujenzi contractors from 1st of January. From 1st of January, this is from January to 2020 December. How many marks? 10 marks. 10 marks. You can see candidates 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 times 4, that is 40. You also get some marks for the workings. These marks are in fractions. Okay, these are fraction of marks. When you put them together, you score the 10 marks. We have done question number 2, financial accounting. This paper was done in May 2021 on Monday 17th May 2021. We are going to do question number 3 in our next session. Please try and do it on your own. Then when you are working the questions here on the board, you will be marking your work. Thank you for attending our today's revision session. Goodbye.
Welcome to Manifested Publishers. Hello students, welcome to Manifested Online Classes. My name is Mr. Kimani. I want us to continue with the revision for financial reporting and we'll still continue with the revision for November 2019. And in this session of this class, I want us to look on question number 2. Basically, that question came from the topic of published financial statement, which is basically a common question in this paper. And you go through the question, it reads, the following trial balance has been extracted from the accounting record of Skytex Limited as at 30th September 2019. So in our case, you're given the trial balance. First of all, we have 6% convertible loans. Loan notes, and then we have ordinary shares, we have retained earnings, revenue, cost of sales, distribution cost, administrative expenses, inventory as at 30th September 2019. We have trade and other receivables, trade and other payables, finance cost, investment income, current tax, deferred tax, property at cost. We have accumulated depreciation on 1st October 2018. We have plant and equipment. We have it accumulated depreciation. We have bank balance. We have investment property. And then we have suspense account. And then from there we have additional information. In the additional information, we have note 1 up to note number 7. We're going to go through that as we have some workings. And then if we go to the requirement there, we require to prepare the following statements, the following financial statements, suitable in a suitable format for publication. 1, a statement of profit and loss for the year ended 30th September 2019. 2, a statement of changes in equity for the same year. And number 3, a statement of financial position. And then we are told all workings should be done to the nearest 1,000 of a shilling. So basically that question was requiring the preparation of 3 components of a public financial statement, statement of profit and loss, statement of changes in equity, and a statement of financial position. Now, what we need to do, we need to go through the additional information note 1 up to note 7. First of all, we do some workings, and then from there we prepare what is required. So this is the revision. And this still the paper for November 2019. And this is a question 2. This is a question 2, and we start with the workings. So we go through note number 1, and we are told that Skytex Limited entered into a contract with a customer with performance obligation, where performance obligation is satisfied over a time. And then you're told the total contract price was 45 million. With total expected contract cost of shillings 25 million. And then we are told progress toward completion was measured at 50% on 30th September 2018. That is now the end of the previous year, and at 80% on 30th September 2019. That is now the end of the current year. And then you're told the correct entries were made in the year ended 30th September 2018, but no entries have been made for the year ended 30th September 2019. Now, what we need to do in respect to that particular point number 1 in respect to this contract which was entered with customers is basically to determine the amount of revenue which was supposed to be recognized in the current financial year, and also the cost which was supposed to be recognized in the current financial year in accordance with IFRS 15. So therefore, we determine the revenue to be recognized. We determine the revenue and cost to be recognized in the year ended 30th September 2019. So what we are told is that this particular contract in the year 2018 it was 50% complete, and that means that the revenue and also the cost which were recognized in the year 2018 were 50% of the revenue and cost of that contract. And then we are told in the current financial year the contract was basically performed to an extent of or basically it was deemed to be 80% complete. So what that means is that the revenue which will be recognized in the current financial year will be equal to 80%, because we are told the contract is 80% complete, minus what was recognized in the previous year, that is 50%. So mean that during the current year we are going to recognize revenue equivalent to 30%, and then we multiply that with the revenue with the total contract price, which is 45 million. So we get 30% of 45 million. 30%, 0.3 times 45 million. That will give us 13.5 million. Now this 13.5 million, one, it will be accounted for as a revenue, and two, because this amount has not been received, it will also be recognized as a receivable. So therefore, this will be a part of the revenue. It will be recognized as a revenue for the year, and two, it will also be accounted for as part of the trade receivables, because this is just like credit sales, whereby we recognize that as revenue and also we debit that in the trade receivables. Still, we also need to recognize or basically to determine the cost which will be recognized in respect to this contract in the current financial year, and still the computation will be the same, 80% minus what was recognized in the previous year times now the cost of that contract. The cost of that contract is 25 million. So we get 30% of the costs, that's 0.3 times 25. So that will give us 7.5 million. 7.5 million. Now this 7.5 million being the cost of that contract, one, we are going to add it to the cost of sales. We are going to include that as part of the cost of sales. And two, because this cost is yet now to be paid, still it will be recognized as part of the trade payable. So when preparing the statement of financial position, we're going to recognize that as part of the trade payable. So therefore, that what was supposed to be done, and basically that is in accordance with IFRS 15. So we proceed to note number 2, and we are told on 1st April 2019, Skytex Limited has was notified that ex-employees had initiated court proceedings against them for unfair termination. Legal advice was that 80%, or there was 80% chance that Skytex Limited would lose the case and would be required to pay an estimated cost of 5.06 million in damages on 1st April 2020. Based on this advice, Skytex Limited recorded a provision of 4 million on 1st April 2019 and has made no further adjustment. So the provision was recorded in administrative expenses and in trade and other payables. And then you are told Skytex Limited cost of capital is 10% per annum, and the discount factor is 10% for 1 year, is 0.5%. 9091. So basically in respect to this particular legal case which was initiated against the company, basically the company expect to pay some damages. These are form of a contingent liability, and basically whenever there is a contingent liability, a company should make a provision which is equivalent to the present value of what is likely now to be paid. So therefore in respect to that point number 2, what we need to do is basically to determine the provision for the contingent liability, which was supposed now to be made by the company as at the end of the year, that is on 30th September 2019. So the first thing we need to do here is basically to determine what is the present value of these particular damages which will be paid. And in our case, we are told that the damages which are expected to be paid by the company is 5.06 million, and what we need to do is basically to discount this, or basically to get the present value of these particular damages, because we are told they will be paid on 1st April 2020. So 1st April 2020, and basically in our case we are told that that particular legal case was instituted on 1st of April 2019. So what that means is that these particular damages will actually be required to be paid by the company in 1 year's time. So therefore what we need to do is basically to discount that, and basically for us to discount that we need to multiply that with the present value interest factor, which are given as 0.9, that is 0.9091. So we multiply the two, so we get the present value of the damages which will be paid, and basically that will be equivalent to the contingent liability. So the company at the end of the current financial year was supposed now to make a provision equivalent to that contingent liability. So let's multiply these two. So we have 0.9091 times 5.06, and that will give us, to the nearest whole number, it will give us 4600, or basically 4.6. So what that means is that at the end of the current financial year, this company was supposed now to make a provision equivalent to 4.6 million. But what we are told, if you go back to note number 2, paragraph 2, we are told that the company had made a provision of 4 million. So, but in our case, we have said that a company, or this company, was supposed to make a provision of 4.6. So therefore, at the end of the current financial year, the company now will need to make an additional provision which is equivalent to the difference. Our difference in our case here will be equivalent to what? 600,000. So therefore, this additional provision which will be made, it will be accounted for, one, as part of administrative expense, simply because what we are told is that this particular provision which was made of 4 million, it was accounted for as administrative. 2, and this particular provision, because it is money which will be set aside, still it will be accounted for by the company as part of what? Trade payable. So therefore, in respect to that provision, the additional provision of 600,000, we are going to account for it as administrative cost, and 2, we are also going to account for it as a part of the trade payables. Now still, in the last note, or basically in the last sentence of note number 2, we are told Skytex Limited cost of capital is 10% per annum, and the discount factor at 10% for 1 year is 0.9091. So basically what we also need to do is to compute something known as a finance cost, because anytime now a company do have a liability, there is something known as the finance the finance cost. Now the finance cost in respect to this contingent liability, you can compute it here as working 3 finance cost. So the finance cost will be equal to The company's cost of capital, which is 10% times the contingent liability. Our contingent liability is 4,600, or basically 4.6 million. And in our case, we will compute a finance cost equivalent to 6 months, because what we are told, in our case, we are told in our case it was instituted on 1st of April 2019. And what we know is that the current financial year is ending 30th of September 2019. So if we are to count that period, or basically the number of months which we have there, so basically we have April, we have May, we have June, July, August, and then we have September. So basically these are 6 months. 6 months. So therefore, the finance cost which will be recognized in the current financial year will not be for the whole year, but rather it will be for 6 months. So therefore, what we need to do is basically to multiply that with 6 all over 12, and basically we get now the amount which will be recognized as a finance cost for the current financial year. So we have 10% times 46 times 6 all over 12, and basically that will give us 230. Now, this particular 230, one, it will be included as part of the finance cost, and two, because it had not been paid, still it will be recognized as part of the trade payable. So therefore, you can say that this will be part of our finance cost, and two, it will be part of the trade payables. It will be part of trade payable. So in our case, we are through with that particular point. So let's move to the other note, that is note number 3. In note number 3 is about depreciation, which is a little bit simple. We are told the company's policy on depreciation is to charge depreciation on building on straight line basis to a nil residue value at the rate of 2% per annum. And then we are told in the other sentence, the plant and equipment should be depreciated on reducing a balance basis at the rate of 12.5. So what we need to do, we can have now working for here. We need to compute the depreciation for the current year. So the current year, we have to remember ended 30th September 2019. So one, we compute the depreciation on buildings. And we are told that depreciation will be computed on straight line basis at the rate of 2%. So we take 2% of the cost, because depreciation is on straight line. Now, if we go back to the trial balance, we go to where we have property, because we know property includes land and building. So we have the value of land there being 60 million. So mean that the difference there represents the cost of our building. So if we take 170, so these include the cost of land and building, we less the cost of land, which is 60. So we will be left with the cost of building. So we get now 2% of that. So let's compute that. We have 110,000 times 0.02. That will give us 2,200. And then we also compute now the depreciation as per note number 3. We compute depreciation on plant and equipment. And we are told depreciation here is computed at the rate of 12.5% of what? Of now the net book value, because it is computed using the reducing balance basis. So we take the cost. If we go back to the trial balance, the cost in our case for plant and equipment is given as 56. And then we less the net, not the net, rather the accumulated depreciation, which is 18,000. And then we get now the depreciation for the current year. So let's compute that. So we have 56,000 minus 18,000 times 12.5 times 12.5%. So that will give us 4750. So basically in our case now, from that we can compute the total depreciation for the year. And the total depreciation for the year for the two assets,